The Walker F. Todd affidavit, a court case in circuit court in Michigan, where it was a foreclosure, and the defendants brought in a professional witness to talk about the mortgage alleged debt, right? And the allegation of the debt is based upon whether there was actually any money loaned to the homeowner by the bank. And so the expert witness, Walker F. Todd, if you want to scroll down to the first highlighted part, we've got his credentials. I don't remember exactly what they are, but he worked for the Federal Reserve Bank, I know that. Okay. For 20 years, I worked as an attorney and legal officer for the legal department of the Federal Reserve Banks of New York and Cleveland, which are, major Federal Reserve banks in the system. Okay, so presumably he knows what he's talking about, and what he's going to do is kind of break down modern money mechanics in describing to the court how money works. Okay? In a fractional reserve banking system like the United States banking system, most of the funds advanced to borrowers, assets of the banks, are created by the banks themselves and are not merely transferred from one set of depositors to another set of depositors, or to another set of borrowers. In other words, they're not loaning their own money, and they're not loaning other people's money. They're creating money with each transaction. With the exception of customary stores of value like gold and silver, the monetary base of the economy largely consists of credit instruments. Against this background, I conclude that the note, despite some language about lawful money, but he's talking about the mortgage note that's in question here, okay? Despite some language about lawful money explained below, clearly contemplates both disbursement of funds and eventual repayment or settlement in money of account. That is, money of exchange would be welcome, but is not required to repay or to settle the note. Okay? So it's talking about this fictitious sort of this electronic money. It's money of account. It's that's all that's required to settle the note, because that's all that was ever loaned, if anything was loaned at all. That's all that was ever contemplated in the mortgage document. Lawful money was the form of money of exchange that the federal government or any state could be required by statute to receive in payment of taxes or other debts. This is talking historically now. Okay? In light of these facts, I conclude that plaintiff and defendants exchanged reciprocal credits involving money of account and not money of exchange. No lawful money was or probably ever would be dispersed by either side in the covered transaction. Okay? In what form of money or credit is the repayment obligation due? Well, if in a mortgage note situation, they're not expecting you to walk in there with a bucket of gold, right? They're not expecting you to walk in there even with US dollars, because there aren't any in circulation anymore. It's only Federal Reserve notes, and which are credit notes. Okay? Legal tender, a related concept, but one that is economically inferior to lawful money, because it allows payment in instruments that cannot be redeemed for gold or silver on demand, has been the form of money of exchange commonly used in the United States since 1933. Okay. The referenced official comment notes that the definition of money is not limited to legal tender under the UCC. The narrow view that money is limited to legal tender is rejected. Credit as money. PJ? You with me?
I think we should point out that I don't know if we have a little bit of a delay, but he has a great definition here of money.
Go ahead.
I'm going to read that. That's a medium of exchange authorized or adopted by a domestic or foreign government, and includes a monetary unit of account established by an intergovernmental organization or by agreement between two or more nations. It's very interesting, I thought.
The typical forms of such extensions of credit was drafts or bills of exchange drawn upon themselves, claims on the credit of the drawees, instead of disbursement of bullion, coin, or other forms of money. And in transactions with third parties, these drafts and bills came to serve most of the ordinary functions of money. So this is good, getting back, and he runs through some of the history, and he's talking about how credit money builds upon primary money. Thus, credit money is not alien to the current official monetary system. It is just rarely used as a device for the creation of Federal Reserve credit that, in turn, in the form of either Federal Reserve notes or banks deposits at Federal Reserve banks, functions as money in the current monetary system. Advances of bank credit is the equivalent of money. It is not an unreasonable argument to state that plaintiff apparently changed, which is the bank, apparently changed the economic substance of the transaction from that contemplated in the credit application form, agreement, notes, or other similar instruments that the defendants executed, thereby changing the costs and risks to the defendants, which creates at least the inference of inequality of obligations. In other words, they were asking for a repayment in lawful money, but they were only lending money of account, if they loaned anything at all, which is still in question. This would show that the bank received the customer's signed promise to repay as an asset, thus monetizing the customer's signature and creating on its books a liability in the form of a demand deposit or other demand liability of the bank. Okay, hang right here for a second. This is the meat of what I wanted to get at in this thing. The bank received the customer's signed promise to repay as an asset. They took it onto their books as an asset. The promise to repay is the mortgage note, okay? And they accepted it as an asset and then monetized the customer's signature, creating on its books a liability in the form of a demand deposit or other demand liability of the bank. So where does the money come from to buy the house? The signature of the buyer creates the money into the system. The bank takes the note as an asset on its books and then creates the liability in the form of a demand deposit. So all of it originates from the signature of the home buyer or the mortgage applicant. Okay, that's how money gets created. What we call money today gets created into being by the energy of the individual who fills out a credit application. Pretty much anything that has a social security number and signature on it, or an all caps name, all capital letters name, person, and signature, is creating money into the system. A loan application, a credit card transaction, a mortgage note, all of these things are creating money, and the banks use that money to loan you back something that you then repay over your lifetime with interest, whereas they didn't actually own that asset until you gave it to them. So they're lending off of your commercial energy. All right, let's go a little deeper here. According to the Federal Reserve Bank of New York, money is anything that has value that banks and people accept as money. Money does not have to be issued by the government. Money does not have to be intrinsically valuable, be issued by government, or be in any special form. The bookkeeping entries tend to prove that banks accept cash, checks, drafts, and promissory notes, credit agreements, assets, as money deposited to create credit or checkbook money that are bank liabilities, which shows that absent any right of set-off, banks owe money to persons who deposit money. Cash, money of exchange, is money, and credit or promissory notes, money of account, becomes money when banks deposit promissory notes with the intent of treating them like deposits of cash. Now, obviously, everything in here, the parts that I'm skipping, I'm just reading my own highlights, but the parts I'm skipping are valuable as well. And this is not a very long document, and I suggest that everyone go back and read this now that it's posted in the homework section. But I just want to hit these highlights because it raises interesting questions for discussion. The newly issued credit or money is similar or equivalent to a promissory note, which may be treated as a deposit of money. This explains that when the banks, the Federal Reserve Bank of Dallas publication Money and Banking, page 11, explains that when banks grant loans, they create new money. Modern Money Mechanics, page 6, says what the banks do when they make loans is to accept promissory notes in exchange for credits to the borrower's transaction accounts. The next sentence in that on page 6 says, explains that the bank's assets and liabilities increase by the amount of the loans. This is, it's money out of thin air. The plaintiff, in fact, never lent any of its own pre-existing money. Remember, the plaintiff is the bank. The bank never loaned its own pre-existing money, credit, or assets as consideration to purchase the note or credit agreement from the defendants, the homeowner. The plaintiff is trying to use the credit application form or the note to persuade and deceive the defendants into believing that the opposite occurred, and that the defendants were the borrower and not the lender. See, the truth here is that since the commercial energy comes from the signature on the note, that creates the money which the bank deposits as an asset. The truth of the money situation in today's economy is that you are the creditor and the bank is the borrower. You are the creditor. Creditor comes from creator. You create the money by your signature, and the bank borrows the instrument from you, the note or the loan application or the credit card receipt or whatever, and they use that in the fractional reserve banking system and loan it out from there. And make a ton of money off of your signature, and then they come after you and say they loaned you money and expect you to repay with interest over years. Okay? Lawful money language in the repayment clause of the note is confusing at best, and in fact may be misleading in the context described above. Right. Okay. Now let me break that down. This is based on what I'm going to share with you here now is based on how I used to do when I was helping people with mortgage with foreclosure situations. This is how I would break it down to them. Okay, applying the principles outlined in Modern Money Mechanics and reflected there in the Walker Todd Affadavit. The bank, the alleged lender, doesn't loan the alleged borrower the bank's own funds, as reflected on the face of the note, which is the alleged borrower's promise to repay. The borrower does not receive a loan from the bank, let alone a loan prior to the date the note is signed, as the face of the note unequivocally asserts by the language, quote, in return for the loan that I have received, which every mortgage note says in similar language to that, right? And it just isn't true. In return for the loan that I've received. Well, you haven't actually received a loan. What actually happens is the bank receives the alleged borrower's signed note as an asset and monetizes the alleged borrower's signature, creating a liability in the form of a demand deposit credited to a transaction account, which is used to finance the alleged loan. That goes back to page 6 of Modern Money Mechanics, which I think we just read, but I'll read again. What the banks do when they make loans is to accept promissory notes in exchange for credits to the borrower's transaction accounts. Loans, assets, and deposits, liabilities, both rise by the amount of the loan. There is no loan. The borrower is the actual source of the commercial energy used to create the funds to finance the alleged loan. The bank merely alleges to be the source of funds and actually loans nothing in exchange for the interest it collects. So this, in a nutshell, is the system described in modern money mechanics. And this revelation is the reason the federal Reserve stopped publishing and recalled modern money mechanics. The Fed didn't like it out, didn't like it out there, and they didn't take it out of print because it wasn't true. They took it out of print because it exposed the truth. You'll find the same description, in modern money mechanics and Walker Todd Affadavit. Both are available to check out at GTEN.org. You were playing something?
Very nice.
Darla asks, they never accepted the loan offer? What was the outcome of the case? Okay, so those are two questions. I don't know what the first question means, Darla, if you could rephrase that. They never accepted the loan offer. The second one, what was the outcome of the case? They lost. The defendants in this case lost, but it wasn't because of the Walker F. Todd affidavit. I can tell you that. I mean, that they found no holes in his testimony, but they lost for other reasons. And the full case is available online. It may even be in the Red Library at GTEN. Not the full case, but the decision. I think the decision is in there. In addition to this document, if you scroll down to the Red Library, I think you'll find that the decision is in there. But it's a complex world navigating the court for a mortgage foreclosure, and they lost on other grounds. What was the outcome of the case? They lost. The defendants in this case lost, but it wasn't because of the Walker F. Todd affidavit. I can tell you that. I mean, that they found no holes in his testimony, but they lost for other reasons. And the full case is available online. It may even be in the Red Library at GTEN. Not the full case, but the decision. I think the decision is in there. In addition to this document, if you scroll down to the Red Library, I think you'll find that the decision is in there.